Welcome, everybody, to Unfoolish Investing. I'm Victor. I'm here with.
Larry, thanks for joining us.
This is like a late night episode 2 podcast for us, especially with all the turmoil that's been going on in the markets from Japan to the US. Um, we're just going to break it down for you, and we're going to jump right into it. While everybody was sleeping Sunday night, the Nikkei opened in Japan, and it proceeded to plummet. And it proceeded to plummet and lose roughly 12%, which, in, in why? And the basic reason why was the yen carry trade. And a lot of people are going to be like, what is the yen carry trade? It's an investment strategy where investors from around the world borrow money in a currency that has low interest rates. In this case, it was the Japanese yen. They then convert that money into another currency with higher interest rates to invest in assets or bonds. And the reason everybody has been using the yen is because the interest rates in Japan have been low for so many years, where the rest of the world was continuing to go up. Um, the Japanese yen continued to be at record lows. And that made borrowing money in yen cheap compared to other currencies, like the US dollar, for instance. And what happens when you do stuff like this is it creates a critical danger. And that danger is leverage. And Larry, what is your view on the leverage issue and what went on in Japan?
I think the big issue with leverage is you can end up losing more than your entire principal investment. So, in essence, if you have a security that's backed by leverage, you can have more at risk than what you're investing. You can lose more than 100% of what you invested. Um, And when the Bank of Japan increased their interest rate, it wasn't a small increase. It was a 150% increase. So to your point about the yen carry trade, all of these investments that were done with almost no interest yen had to start being unwound to pay for that shorted stake in yen. All very sudden, very shocking to the market. It's not something that, as a you know novice, intermediate, advanced investor, that something you wouldn't even be aware of, because this is not something that an individual investor is generally doing. These are like huge hedge funds that are making these kind of essentially gambles. To me, it's kind of like gambling.
I mean, to gambling, would you basically compare it to like margin calls,
Yeah.
where
Yep.
your leverage involves borrowing,
Hmm.
which can lead to margin calls, and if the value of the investment falls, the margin calls require investors to add more money
Hmm.
to maintain their positions. And
Yep.
failure to meet those calls force investors to sell assets at an unfavorable price.
Yep. Yep. And that's what's happening. I mean, you can see it in the entire market. Like it, people see the markets going down, um, and your immediate emotional reaction is, oh my god, like you're panicking. Somebody's panicking. Like, oh, I have all this money tied up, and it's going down. But you have to remember that there's nothing like all of these U.S. companies, these amazing companies that have built so much wealth for so many people over so many decades. Nothing immediately changed with those companies. Like, the investable thesis that you may have for any of those companies didn't change from, last Friday, the 2nd. Today's August 5th when we're taping this. Nothing changed with those companies. Um, so, the thesis is still intact for those companies, and um, the shock to the market, I think, is something that's hopefully very temporary.
I agree. I do hope it's temporary, and I feel like the yen carry trade exemplifies how leverage
Mm-hmm.
could be both a powerful tool
Yep.
and a dangerous risk. I mean, it offers the
Yep.
potential for higher returns, which is what these large hedge funds are looking for. It's
Mm-hmm.
why they're going over to Japan to buy at that time to get the yen at such low rates. But
Yep.
it's that risk management and unknown variable. And in this case, to what you stated a short time ago, it was the Japanese Fed raising rates, not like 1%, not even 5%,
Yeah.
150%.
Yep.
150%. And it, like, for anybody that's listening, like, what we've gone through over the last several years, where the Fed mildly tweaks rates and brings it up a little bit. This would be the equivalent of us going from 0% interest rate, which is essentially where we were a few years ago, to 20 to 25% interest rate overnight. And not warning anybody, just being like, we missed it, we're going up. And that's what happened. And it sent the global markets in an absolute spiral.
Yep. Yep. And I mean, I think it's going to continue for a little bit in the short term, because people have to sell down all these margin bets that they've made. Um, and at this point, it's only been going on for a day. We don't know how long it's going to take. So I think for now, we just kind of have to expect the unexpected, um, because we're not sure how deep this goes or how long it's going to take. I personally don't think it's going to take a terribly long time, maybe like a week or two. Um, but we're advising people to remain calm and not to sell.
But you know who didn't remain calm, Larry? The
Who?
U.S. stock market. The U.S. stock market. The U.S. stock market, while everybody was sleeping, and then we finally woke up, everybody in the stock market was up way before us, and they were panicking. They weren't just panicking, they were freaking out.
Mm-hmm.
Heads were exploding. What's going on in Japan? You know what we need to do to answer this? We need to sell everything. We need to go through a massive sell off because nothing, I feel like when you have these sell off moments, and I feel like this is the Costanza Fire moment where
Yeah, I think that's a good way of putting it.
where like there's smoke, and instead of being the adult and looking at it, you throw all the kids and the women out of the way, and you go running out the door. And that's how I view what happened today
Yep.
with the Dow Jones falling over 1,000 points, or roughly 2.6%,
Mm-hmm.
marking easily one of the worst days since September of 22. And the S&P 500 and Nasdaq also fell apart, each down
Mm-hmm.
3.5% respectively. And it's like people are like, oh, it's heightened concerns over volatility, economic slowdown. We've had one negative jobs report. One negative jobs report. Jobs
Yeah.
report goes to 4.3%, which is still, I think, roughly 4% lower than it was in, 2012. When I think it was like roughly around this time, it was somewhere around 8.2,
Yeah. Yep.
8.4%. And it was
Somewhere around
trickling
there.
down to
Yep.
7.9. Like, we're at 4.3. We're trying to, the media, the market wants to sell us on an economic slowdown. They want to sell us on panic. Look at what happened over in Japan. We all have to sell.
Hmm.
Like, what's your view on that?
Yeah, I mean, I think some of it too is driven by a lot of these, massive fund managers being judged on a 12-month rolling timeline. Um, so I think they're much more worried about locking in some sort of positive return. Um, yeah, I think they have to be much more quickly reactive in the market than somebody that has a longer time horizon. That's kind of our mantra is buy and hold long term focus. Um, the longer your time horizon is, the smaller and smaller a blip like today will end up being. Um, you know, 5 or 10 years from now, you could look back on today and it wouldn't even be a blip on the chart. Um, but for all these massive fund managers that have to look at each year in a vacuum, um, you know, say this went on for the next few months and they didn't sell anything and it goes, the market goes down another 10%. They just lost a year's worth of returns. Um, where for folks like us, it could be a magnificent buying opportunity.
Agreed, agreed. And do you think this is part of the reason why Nvidia dropped roughly 6.5%? Apple fell almost 5%.
Yep.
Though I will add, back to our previous podcast where we stated Warren and Berkshire had been buying Apple in the span of 48 hours. They have now sold half their stake, which to me I
Mm-hmm.
understand where it's like, okay, you bought it at a low price. You have, and I know the number's going to be close, but it's not going to be accurate. And for us average investors, we can't fathom it. When you have $150 billion worth of stock in a
Yeah.
company that you've made a ridiculous return on, that's selling 0.5%. So you roughly sold 75 billion, but you still have 75 billion worth of Apple stock, which isn't a small amount.
Yeah.
But I
I
will go ahead.
I have his recent 13F filing um, up. He still owns 84.2 billion in Apple at an average buy price of $39.
That's amazing.
Um,
What
and
what,
I
what
think
what
it's
was the
still over
close of Apple
200.
stock today?
209.
Oh, nine.
So, it's
$39.
yeah. Yep, so it's still doing amazingly well.
I will say some positives. Um, you want to take out of the market. U.S. crude prices hit a 6-month low, which really impact OPEC's plans to increase production, which I think is a huge positive. You know, and even though when everything else is selling off, to your point, we need to be steady, right? We need to be calm. We can't look at these short term sell offs as panicking. We need to look at them as buying opportunities where before you had to go in to say Neiman Marcus to buy this stock. Now you're able to, cruise into your local Target and pick it up for a lot cheaper price. And I think that's, or even TJ Maxx. I'll keep it local. But you can now buy that premium brand at a lower cost. And I think that to me is something that, investors should be looking at. Don't look at the media.
Yep.
Don't look at the media. The media is just going to sell you on a number. Oh my God, it dropped 1,000. They're panicking. Yep. They want you to be scared. Do not be scared, right? Long-term investing is about seeing those discounts and buying into them.
Yep. Yeah. If if you love the company and the thesis, the reason that you invested in the first place hasn't changed, like nothing fundamentally has changed with the company. I couldn't agree more. These are the periods that long-term investors, should be salivating for. I'll throw out another Warren Buffett quote where the stock market is the one market where people don't like discounts. People tend to see a stock going up and getting more expensive, and they think they have to buy it because it's always going to keep going up forever and ever. And very rarely does that happen, if ever, if at all. There's always going to be a point where the market goes down. And people are emotional creatures, and when you see something going down, you think, oh my God, it's going to keep going down. So your gut reaction is to just pull out and lock in some sort of return. And really your reaction should be the opposite. Is not only am I not going to sell if I still love the company, if I bought a share of Microsoft at 400, well, now it's down to 300. Has anything changed with the company? No. I should love it even more and add to it.
Agreed. And I think that's the key, is understanding that if your investing philosophy and why you bought that company still stands, for whatever reason, buy into these discounts. Do not buy into whatever the media is pushing out at you as to whether or not, I won't digress into the last 2 years, but was that recession?
Yep. They've been forecasting it for years, to your point.
And the last time I checked, you can't forecast a recession. They just occur. But I feel like we've become into this investing, marketing, media world where they're trying to push narratives on investors. And that's when people make mistakes. Because over the span of every year, there's a few key buying opportunities. And if you try and time them and you're not in the market because you sold everything, you end up missing them. And that's the key in why you want to stay in the market and invest in the long term. Just kind of closing things out a little bit. We went to sleep on Sunday. Nikkei was plummeting. We woke up, the stock market was plummeting. As of this recording, on August 5th at 10 o'clock Eastern Time, the Nikkei, I believe, is up 10.5%. So that 12.5% plunge in the span of 24 hours, if it sticks and we wake up tomorrow to, a 10.5% raise, it will have erased almost this entire plunge in less than 24 hours. Less than 24 hours.
Yeah.
And that's why you can't sell and panic, because you can't watch the day to day. You just can't do it. What are your thoughts?
Right. Not only do you not panic and sell, um, you want to have some cash ready so that when this stuff does happen, you can capitalize on it quickly. Because to your point, this could be gone tomorrow, could be gone in a few days, could be gone in a couple of weeks, and you had that short window where you could buy at a discount. And if you're totally leveraged in stocks and you have no cash, you can't capitalize on it without selling out of the market to buy back in, which most of the time doesn't make sense.
It's so true. It's so true. And I just said, you shared a Warren Buffett quote with me. I want to share one that I really enjoy. I actually made a slide of it. It's sort of something I do. Let's see if I can bring it up.
Let's see it.
Basically, what it says is if you worried about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, because it's going to go down sometimes, if you own a stock, so why worry about it? The point is that you buy something that you like at a price you like, and then you hold it for 20 years. You should not look at it day to day. If you bought a farm or an apartment house, you would not get a quote on it every day or every week or every month. So it's a terrible mistake to think as stocks is something that bob up and down, that you should pay attention to all those bobs up and bobs down. And when I think about that quote, and I love Warren Buffett quotes because they kind of they get me thinking on these down days. Like,
Mm-hmm.
turn off the media, don't look at it, don't panic. Who cares?
Yep.
Look at the be like, oh, to your point, I own Microsoft. It just went down 150 points, $150. Maybe I should buy it. Maybe I should be buying this opportunity before people realize, oh, wait, there's nothing really wrong with that company. I'm supposed to be
Yep.
in that. Why did I just sell it? And then it
Yep.
goes back up. Thoughts?
Yeah, I mean, I couldn't agree more. Generally speaking, you look at long-term charts of all the major indices, and they just go up over time. There's blips, obviously, here and there, but generally, if you're looking 5, 10, 20 years, you're going to start lower on the left-hand side of the chart, and you're going to end up higher on the right side of the chart. And, that's really what you need to worry about is the right side of the chart, which is 20, 30, 40 years down the road for most folks. So,
Because
stay
big
in.
drops are not a big deal.
Nope.
And
Nope.
I want to share one more acronym with the audience. Something that I think that I have it pinned up. I love it. I look at it, read it, and that's stock. What does stock stand for? Stay long-term focused. Remember to keep your eyes on the future and not on the daily fluctuations. T, tune out the noise. Avoid getting distracted by the constant ups and downs of the stock market. O, own what you believe in. Invest in stocks you have confidence in and at prices you deem fair. C, corrections are normal. What we are going through to a certain extent right now is a correction. Every now and then, indexes are going to pull back. 10%, 20%, sometimes 30%. It's normal. And it happens so quickly. It's not like this gradual decline. That's when everything's going up that it goes gradual. When things drop, it goes fast. And it seems scary. But corrections are normal. understand that it's a natural part of investing. And Kay, and I think we've talked about it a lot today, keep your emotions in check. Maintain emotional resilience and avoid panicking on downturns. I think that if people look at stocks like this acronym, it kind of takes away the scariness.
Yeah, I agree. I think this slide's a reminder to just kind of take a deep breath before you do anything. In these periods of, like you said, where it can cause panic, it might be best to just take a deep breath. And if you're not going to, or you're not able to capitalize and add, it's probably best just to not look at the stock market for a while and let it play out. And just keep a level head.
I agree. I couldn't agree more. So, I mean, with everything that we just went through today in the U.S. market and overnight in Nikkei, and we see things starting to turn around in the Nikkei in Japan, I'm pretty positive that if Japan ends up dramatically for the day, everybody, and I'm not going to be a fortune teller, I'm just going to put it out there, I'm going to imagine there are going to be a lot of people with regret in the morning and all those stocks that went down are going to go back up. Thoughts on that in closing?
We'll see. It'll happen eventually if you stay invested long enough. It's bound to go back up. But if the Nikkei holds like this overnight, when we wake up in the morning, we could be in for a big gain tomorrow.
I couldn't agree more. Well, Larry, I don't want to keep you anymore. This has been an amazing late night episode 2 podcast of Unfoolish Investing. I'm one of your hosts, Victor, with my friend Larry.
Thanks, everyone. Appreciate you taking the time to watch.
Have a great one.